This video covers Chapter 8. It's an introduction to asset pricing models. The chapter is going to work from Markowitz's portfolio theory and lead us right into the capital asset pricing model, which is where we stand today, basically. Asset pricing models are the way to go in terms of figuring out, how do you value a stock. Now, let's go over some of the Markowitz portfolio theory that we discussed in the previous video, because it's important we pick up on that, because we're just going to continue with the story from Markowitz right up through the capital asset pricing model. So the last video we talked about the efficient frontier, and here we have individual stocks, the X's. They have a fair amount of risk, and risk is measured by sigma here, total risk, standard deviation. So you have these individual stocks, and if we form a portfolio between two of these, for example, because of the fact that the correlations on average are less than 1, we get some benefits of diversification, and we can have this bowed out shape in some cases, depending on the correlation. The lower the correlation, the more bowed out you can be. So you can actually be at a point that actually has less risk than the range of the two stocks in the portfolio, but you still keep the range of the expected return. So this is extremely important to know, and so that's where Markowitz's work helped figure that out, that you get these benefits of diversification by finding stocks that have low correlations with each other, and you get rid of the risk and you still keep expected return. So you have this entire universe of stocks that are available to investors. Redraw it here. And if we form a portfolio between all of these particular stocks, we would get something that looked like this. And this is what we call the efficient frontier. It's a set of points. There's a point at every place right here, all the way down, including these are little dotted too. Now I leave these as dots, and I'll explain it in a second. But what I'm doing here is we're forming portfolios of all of these stocks, and when you form portfolios of stocks, you get benefits of diversification that move you out in this direction. And the best you can do in terms of getting high returns and low risk, so here, low risk, is this efficient frontier. Out here is unattainable, in here is attainable but inefficient. So your goal is to get on this line, because when you're on this line, you're maximizing your utility, and utility, say through measure of an indifference curve, would look like this. And so you get the most utility you possibly can at this tangent point. If you try utility with lower amounts of utility from an indifference curve that looks like this, well, this may be 13 units of satisfaction. This may only be 10. You're not optimizing at a point here or a point here. You're better off moving in this direction. And how do you get here? Well, you get here by changing your weights that you're investing between all of those securities. So you're looking to optimize, and you're looking to optimize from two different perspectives. You can think about that optimization. You say for a given level of return, you want the minimum amount of risk, which means you come right here. The minimum amount of risk you can have is right here, given say a 14% expected return. Anything out here is too risky, and it's not the minimum amount of risk. So the best place to be is here, given a return, or given a level of risk, say 25 standard deviation. What's your maximum return? So you come up to this point. That's your maximum return. Anything down here is too low of a return. Up here is unattainable. So this is the efficient frontier from two different angles, the way you define it. These points that are dotted down here are inefficient, because if you pick a standard deviation, say of 20 here, what's the maximum return? It's not here, it's up here. So these are inefficient. This is an inefficient area. But nevertheless, if you did the math with all these particular securities, you would get a line that reflected, that would start here and curl up and around, up over in this direction. But these designated as inefficient areas on the curve. So we also talked about last video, that this point, the optimal point that we could get as a whole, has to be point M, which was the market portfolio. And so we did some math, and we realized that the market portfolio represents the average covariance, or I should say it the other way around. We basically showed that what really matters is the average covariance between stocks, and that the market can represent the average covariance between stocks. And so what I'm going to do here is I'm going to show you what we have risk here. You can think of it as measured by sigma. And here we have the number of securities, number of stocks you can think of. And so when we have formed portfolios, we get rid of a lot of risk, but we don't get rid of it all. So what I'm showing you here is, look, if you have a portfolio of one stock, you have a lot of risk, a lot of total risk. And if you get a portfolio and randomly pick another stock, you'd have less risk because you'd have the netting effect in the offset, as the returns would not quite be in sync with each other, right? And if you randomly pick a third stock, you'd come down to here and so on. And so you would eventually come down to holding a lot of different securities, and you'd basically be holding the market at some point. You'd run out of securities to invest in. And at that point, you would have gotten rid of all the risk, the individual risk associated with particular stocks. And what mattered then would be the average covariance, which could be represented by the market portfolio here. So what we need to do is we need to figure out and try to better get a handle on what this point is right here. In other words, the risk that we want to use to evaluate stocks and portfolios should not be sigma, because that measures total risk and then incorporates the risk of individual securities. What we want to do is we want to ignore that individual risk, get rid of that individual risk in our calculations, because what we find is that we should be holding up the market portfolio, because the market portfolio is the most efficient portfolio that we have. It gets rid of all this unsystematic risk, and that we don't get compensated for unsystematic risk. So what happens is, what we want to do in this chapter is really about finding what this guy is. What is this measure of risk that's associated with the market? And how can we better define it? So we're going to get into some assumptions here. We're going to get into the assumptions of this chapter, capital market theory. And that's what it's called, capital market theory. And in this chapter, we're going to introduce the risk-free rate, which I said before in the last video was absent. And we're also talking now about the market portfolio. So we explicitly are bringing the market portfolio into this analysis. So now, the assumptions of the capital market theory are that all investors are Markowitz efficient. In other words, they seek that tangency point. They seek this tangency point for the market here. Okay? And that's where investors are going. That's what they're seeking. And that depends on their level of risk aversion, just like your indifference curves tell you how much, or reflect your levels of risk aversion. Now, we're only worried about in this chapter, and in fact most of the textbook is only worried about portfolios of stocks. We're excluding from the analysis all other types of assets that you could have. For example, we're going to ignore human capital, which generates labor income. So we're going to abstract away from that, abstract away from real estate, so that you really are an investor that all you do is hold a portfolio of stocks, and you're unemployed and you don't own any real estate, you don't own a home. And the reason for that is we want to zero in, we want to focus solely on how to price a stock, how to evaluate its value as a function of and relative to the average stock in the market. So how does stock I, individual stock I, behave relative to the market? Because our only source of risk is our stock portfolio, because we don't have it, we don't own anything else. Now, another assumption is that each investor's endowment of wealth is small relative to the total endowment of all investors. In other words, each investor is relatively small, so nobody can have price impact and move stock prices around. We're going to assume for the moment, and really for most of what I want to talk about, is that the risk-free rate applies to us in both lending and borrowing situations. So when we borrow money, we borrow at the risk-free rate, and when we lend money, for example, lend to the U.S. government when we buy a treasury bill, we're lending at the risk-free rate. We're going to assume that investors can buy and sell fractional shares, that there's no inflation, because inflation adds another risk component that we don't want to deal with. Interest rates are constant, and changing interest rates could be a risk that we want to ignore to keep things simple. And, by the way, all these assumptions are taken apart, pulled apart, and analyzed in the literature in detail to see what effect it has on the model. But when you want to understand the model from scratch, you got to abstract from all that, and that's what we're doing. We're looking at no market frictions. There's no taxes or transactions costs. All investors have the same relevant information about stocks in the economy, and they all have the same expectations over the next period. And usually we assume the next period is a year, and then that all stocks are appropriately priced given their risk, so that the market's in equilibrium. You always want to start out in equilibrium, because you don't want to start out in disequilibrium, because you got to first explain how you got into disequilibrium. And in order to explain how you got into disequilibrium, you kind of have to explain what an equilibrium is and how you got there. So it doesn't really, you just get lost trying to start anywhere else but a market equilibrium. Okay, so now what we want to do is we want to bring in the risk-free asset into the math, and the market portfolio into the math. And so what I want to do here is I want to look at the expected return of a portfolio that's invested some of its money in the market, in the risk-free rate, the risk-free asset, and some of its money in the stock market. And so here what I've done is, look, I got a portfolio that's composed of the risk-free asset and the expected return on the market. Okay, stock market, say the S&P 500. And I'm saying, look, I'm putting this much weight on the T-bill and this much weight on the market. So the way I've defined it mathematically is that no matter what happens, this adds up to 1. The weights add up to 1. So it's just a trick to make sure that the weights add up to 1. And all I have is I got to basically, you can think of this as two assets in my portfolio, market portfolio plus risk-free asset. And a simple weighted average of them. The risk of a portfolio is simply the risk, the variance of the risk-free plus the weight, and so that's the weight squared around the risk-free times the variance of the risk-free, the weight squared of the market times the variance of the market, plus 2 times the weight of the risk-free times the weight of the market times the covariance between the risk-free and the market. And we know that this guy, right, the variance of the risk-free asset, how much risk is in the risk-free asset? In other words, that doesn't make any sense. We know that that's zero. There's no volatility in that. And that we know that the covariance between the market and the risk-free asset is zero. So what I'm saying is the covariance of any asset with the risk-free asset, such as a T-bill, is always zero, because mathematically this component boils down to the correlation of the risk-free asset and the market times the standard deviation of the risk-free asset times the standard deviation of the market. Right? So this is always zero, which means this whole thing cancels out, which means this whole term cancels out. And all we're left with here for this equation is these components. And so what we want to do now, so what we've done, so don't get lost in this math. What I've done so far here is I said, look, the return of a portfolio is simply a weighted average of the returns of the stocks in the portfolio, of the assets in the portfolio. And the risk of a portfolio is nothing but the risks that are coming from the individual securities in the portfolio. That really doesn't tell us a whole lot. It really doesn't. What we want to do is we want to look at what drives expected returns in terms of risk. Because what I'm saying here is that risk drives expected returns. But you can't see it, for example, in this equation. So what I want to do is I want to take these two equations that I have and I want to combine them into one so that risk drives returns. And the way to do that is to realize that these two equations have the same weights in them. See the W's? The W's are in these equations, and so I can take advantage of that. And if I can solve this equation in terms of weights, I can substitute it into this equation, the top equation, and try to make a little more sense out of it from a risk and return perspective. So I just rewrite this. Sigma squared P equals WM squared sigma squared M. Just rewriting. All I'm doing is taking this component and putting it down. And so if we rearrange, we get the weight squared is equal to the relative risks. The risk of the portfolio relative to the risk of the market. That's what that's saying. It's just that there is an interpretation of that. How much risk does your portfolio have relative to the risk of the market portfolio? Now take the square root of both sides and we get weight of the market, how much money you should invest, the proportion, now this has got to be between 0 and 1, is going to be the relative relationship between the portfolio's risk and the market's risk. Okay? So now what I'm going to do is I'm going to substitute this term all the way up into here and into here. And when I do that, I get this. Now, notice what's happened so far, that simple substitution. And this substitution is coming from the risky part of the equation, is now I've got an expected return of a portfolio that's not only a function of the risk-free asset and the return on the risk-free asset, the return of the market, but it's also a function of risk, because when you see sigmas, you're looking at risk. Now, rearrange it so we get something that looks kind of pretty and we wrap our heads around it a little better. Mathematically, multiply this out, and you can simplify it, and you get the expected return on a portfolio between a treasury asset, say, and the market of stocks is equal to the risk-free rate that covers the opportunity cost of money and the relative risk of your portfolio to the market times the expected return of the market minus the risk-free rate. That market risk premium right there. So what it says is, look, the return that you're going to get on a portfolio is going to equal the opportunity cost of money, right? Because if you had no risk, if you invested in something with no risk, this sigma would be 0. This whole term would cancel out, and all you'd be left with is the return on the risk-free rate. But when you have risk, the risk depends on a couple of components. How much risk are you taking? So how risky is your individual portfolio right here? That will drive your expected return up. But it's also a function of the amount of risk premium that's in the market. So how much extra return does the market expect to get over the risk-free rate at any given time? Now, I can graph that. Let's see if I can graph this. Help you a little bit. So here's the risk and return plane here, and we got an equation for a line. This is a line where here's the intercept. Here is the slope right here in the brackets. Most people are used to seeing the slope. They think that this is the slope, but this is the slope, and this slope is constant because it applies to every stock. And so this sigma p varies for each portfolio. So that can't be the slope that I'm going to draw, because I'm going to draw the slope of a straight line, this. And it goes from the risk-free, right, all the way up through the market portfolio, M. And this will be sigma M. This will be the expected return on the market. Now, the way to read this is, look, the way to read this is, if we are happy with the risk, as an individual investor, we're happy with the risk that the market itself has, then we could put all of our money in the market, and we'd be happy with it. We'd have, our indifference curves would be such that, you know, we'd be optimized if we were happy with that market portfolio. So we'd be right here, and we'd be the best we could at moving in this direction up to the northwest. We'd have a maximum indifference curve at that point if we liked the risk and return trade-off that the market gave us. But let's say we're nervous about risk, we're highly risk adverse. If we're highly risk adverse, then we're going to lend. And if we lend at the risk-free rate, when I say lend, we're lending at the risk-free rate, then we're going to be along here somewhere. And if we put 100% of our money in the T-bill, we'd have this expected return, which would be quite low, and we'd have no risk right there. If we decide to allocate some of our money between the market and the risk-free rate, like maybe half and half, then we'd be probably around, right about here. This is where our portfolio P would be. Right about there, halfway in between. So we'd be lending. Who would we be lending to? The U.S. government. Now, if we thought that, you know, oh man, you know, this market's pretty boring. It doesn't have enough risk for me. You know, I'm not very risk adverse. I'm very risk tolerant. So I want to actually borrow at the risk-free rate. And when I borrow at the risk-free rate, I have to invest the money somewhere. I invest it in the stock market, and I'll be up in this area. So if I borrow at the risk-free rate and invest in the stock market, it'll be up here with a high amount of risk and a high amount of return. And that would be consistent with my indifference curves and degree of risk aversion. Okay, now, we could go a step further here and say, look, the expected return on the portfolio equals the risk-free rate plus the relative risks times the market risk premium. Right, we have that. And let's get the risk premium on our portfolio here. Oops, minus, that's a minus, RF. So all I'm doing is I'm taking this over to the other side and saying this equals sigma P, sigma M expected return on the market minus the risk-free. And what I could do is now divide both sides by sigma p. And I get expected return on the portfolio minus the risk-free divided by sigma p equals the expected return on the market minus the risk-free over sigma m. And what I'm seeing here is that, look, the risk-adjusted return, your Sharpe ratio for your portfolio, has to equal the Sharpe ratio for the market. Now let's continue with an example. So here we have an example where we have two securities to invest in, the S&P 500 and the T-bill. And we have an expected return for each. That's 0.5% for the T-bill. And then the risk for each is 0 for the T-bill, obviously, and a standard deviation of 40% for the stock market. So here we see these conditions here. We see interest rates are very low in the market, and interesting. The market doesn't have a very high expected return. People don't anticipate the market to do very well, 10%. And the market's quite volatile. And so now the question is, if you can't read it, what is the expected return or risk of your portfolio? Let's graph it out and look at it a little more closely when we get the answer here. So the expected return on the portfolio, right, is, well, before you go any further, I need to tell you how much weight are you putting in each one of these securities. So let's say we put in 90% here and 10% in the stock market. Because look, we're a little nervous. That number is kind of big, so we're going to be shy away. We're going to put a little bit of less risk, and we're going to put less weight into the S&P 500. We're going to put a lot in T-bills. So that's going to tell us that our portfolio is going to look a lot like this T-bill. And so that's what we should end up with. So our expected return is 90% with a 0.5% return plus 10% with a 10% return. That equals 1.45%, which is fairly low. And the risk of our portfolio will equal weight squared. I'll just write it out. Okay. Now here, this is the weight that we have in the T-bill times the risk of a T-bill, which is 0, so that washes out. And then we have the weight 2 times the weights that we have in each asset times the covariance, and the covariance is 0. So remember, I told you the covariance of the T-bill with anything is always 0 because of the variant, because of this guy right here, 0. So what this boils down to is this boils down to 16 right here, this term. So this cancels out. This boils down to 16, and we got the standard deviation of the portfolio to be 4%. So we can graph that now and see what we get. So the stock market is fairly risky with a 40 standard deviation, expected return of 10%. So here's the market. Here is the risk-free rate at 0.5. And so we know that we're going to be somewhere here. If we're going to lend it and buy T-bills, which means we're lending to the government, we're somewhere along here on this straight line. And since we're lending, we're certainly in this area. But we put 90% of our money in the T-bills, so we got a 4% sigma, and we got a 1.45% standard deviation. So our portfolio is right at that point. And that's optimizing. We picked. Now, as individuals and portfolio managers, all we can do is influence the weights that we have. That's all we can do and manage. And that's what portfolio managers do. They manage weights only. Well, we pick these weights because of our indifference curves are being maximized, the highest point. that we can get in this moving in this direction is right here with this weight. Had we decided to invest and put more weight in the market and moved up this line, look, we'd be getting less utility out of this because we'd be on a difference curve that was inferior. And so we don't want to do that. And if we moved even further up, we'd be even at a more inferior place. So this is the optimal place that we could be. And that optimal place is what we look at when we look at the risk and return that's going on in the marketplace. We determine the weights and we end up at a point that we're most comfortable with. That's what you're supposedly doing in Stock Tracker. You're supposed to be doing in Stock Track. You're supposed to be evaluating the market as best you can and having expectations about what the market is going to do, which most of you do. And then you throw into the mix, each one of you throw in your own degree of risk aversion into the mix, and you come up with a portfolio. Now, you say, well, what do you mean? Well, many of you put together a portfolio. It took a little bit of time to put together the portfolio of risky securities. So what many of you did, not knowing this idea, is you pick stocks, individual stocks. You formed inferior portfolios. You didn't pick the market portfolios. Some of you did by going into the S&P 500, but some of you picked inferior portfolios, which meant you were in this area. But you retained a lot of, because you didn't know what you're doing initially, you retained a lot of the risk-free asset. And how did you get the risk-free asset? You just parked your money in cash. You just left it there at a 3% return. So you were here at a 3% return, and so you're toggling between some inefficient portfolio here and your risk and your 3% return. So you're somewhere in this area. So you could, now that you know a little bit more about asset pricing models, and if you believe in these asset pricing models, you could hold well-diversified portfolios, start to look like the market, and and then you can still hold some cash, depending on where you want to be, and you could optimize your portfolio given your risk preferences in the market. So now, to summarize where we are at this point, we're looking at the expected return of a portfolio equals the risk-free rate, the relative risk of your portfolio to the market, times the market risk premium. This is a measure of expected return given risks that we face. What we want to do is we want to transform this into an equation that works for all securities. Basically what we're looking at is this equation only applies to well-diversified portfolios, right? And so what we want to do is we want it to apply to all securities. And so what we need to realize is what we saw, and I'm going to cover it again because I end up using this graph a whole bunch of times. What we're going to do is keep taking into consideration as you add more and more securities to your portfolio, you get rid of this company-specific risk and you're left with systemic risk. Again, we need to figure out a way to measure this systemic risk. Right now, we don't have a good way of measuring that systemic risk at this point. And that's where we want to go, and that's where the capital asset pricing model comes into play. How do I get there? So I'm going to do a little bit of math tricks. And let me explain how the math tricks are going to work. Basically what I want to do is realize that as you move in this direction, you obtain the market portfolio where you have nothing but the market of securities. Because eventually, as you add more and more securities to your portfolio, all you're left with is the market. And so you get into point M as you go out further here. And so when we have M, we have no company-specific risk. All we have is systemic risk, macroeconomic risk, risk that's prevalent to the entire economy. It's the risks that the central bank, the Fed, deals with, and the President of the United States and other top countries' leaders deal with. Those risks. And so what we need to do is we need to pluck those risks out of the entire market, extract only those risks associated with systemic risk. And we want to leave all this risk, we want to leave all this out. And the way to do that is we're going to look at multiplying this equation, put it in green, by rho. So I'm going to take the correlation, right, of a security, portfolio P, and the market. And so what I'm doing is, that's a little m, by the way, if you can't see it. So what I'm doing is I'm going to multiply this term by a correlation of the portfolio relative to the market. So what I'm doing is I'm abstracting only the risk that's related to the market, systemic risk, that way. So if this security had zero systemic risk, right, this correlation would be zero. This whole term would wash away, and we would have the expected return in your portfolio would be that of the risk-free rate. If this correlation was very high and close to 1, it would mean that this whole term would be very large, and your expected return would be quite high. And so that's the first trick that we want to do, is we want to extract only the systemic risk. And then there's another little trick that we want to do, because right now, if we multiply this out, it's not quite as clean as we would like. And there's a trick to making things a little more palatable mathematically. And what we're going to do is we're going to do this trick. We're going to make note that sigma m divided by sigma m equals 1. So that's just a math trick. I'm saying x divided by x is 1, right? But I'm using sigmas. And so let me work this together now. So I have an expected return on a portfolio equals the risk-free rate plus correlation between the portfolio and the market, standard deviation. And so now I just summarize that neatly, right? Oops, there's no sigma here. Get rid of that sigma. That sigma, wipe that out. Okay. So now what this is this guy right here. This is covariance. This is covariance. This is the covariance of a portfolio, right, relative to the market. That's what the top part measures. Covariance relative to the market. It's only extracting risk relative, systemic risk, which comes from the market only, divided by the variance of the market. So the covariance of a portfolio relative to the market divided by the variance of the market, that is beta. So what we have is the risk-free rate plus the beta of the security times the expected return the market minus the risk-free rate. And there we have the capital asset pricing model, which says the expected return of a portfolio is a function of the opportunity cost of money to buy the security or the portfolio times the amount of risk that the portfolio has, and that risk is systemic risk only, right? It's relative to the average covariance, basically, because it's using the covariance of a security relative to the market. And then here we have the market risk premium. And so there you have it. You have, this is the capital asset pricing model. And then there's an equation. It's an equation for a line that's called the security market line, the SML. So now, what's interesting about the security market line in this equation is that this holds not just for well-diversified portfolios, but it applies to all securities. A portfolio of 1, portfolio of 2, any portfolio of securities, because what we're doing is we're extracting out the risk we're only extracting out the systemic risk associated. We're throwing away the rest of the risk. And so what this is saying is, another way to say this is, look, if you hold a poorly diversified portfolio with only one or two stocks, here, you're taking on a lot of risk, but you're not going to be compensated for it, because only the risk that's associated, that's systemic, is going to count. The risk that's company specific, that's in that stock, doesn't count, because look, all we took and we extracted was the risk of the systemic risk by multiplying it by the correlation of the portfolio to the market. Or in this case, now that we're down here, we're looking at individual securities. So you can replace this P. This P can be replaced by a little I. So you can put a little I there. And so now what we're saying is the risk, and we should put a little I here, for risk of an individual stock, the expected return, the expected return of an individual stock equals the risk-free rate plus a measure of systemic risk associated with that particular stock times the market risk premium. And that's the security market line. Now, that security market line can be graphed. So let's graph it, and the graph is important. And the graph now is this. Risk is measured by beta on this axis. You still have expected return on the upper axis, so we have a risk and return plane, but risk is now defined only as systemic risk, the portion that we extracted out that's related to the market, and all company-specific risk has been thrown out of this model, because you don't gain expected return from anything but systemic risk. That's what that's saying. You don't gain any expected return except from systemic risk. Now we have an equation for a line that's called the security market line, and as I said before, somewhere along the way before, when you see a line that says, you know, for example, the capital market line we saw earlier, and here we look at the security market line, when it has that M in there, it means it's going through the market portfolio. And so the market portfolio has a beta defined to be 1.0. The beta of the market is equal to 1.0. And we can check that, because beta of the market is the covariance, right, between the market and itself, right, divided by the variance of the market. And we know that the covariance with itself, remember that variance covariance matrix I did in the previous video? That basically tells you this is variance of the market divided by the variance of the market, and that equals 1. So what we've done is we've anchored everything relative to the beta of the market, which is 1. So we scaled, and everything's relative to this beta. And so when you have stocks that have betas greater than 1, we move up in this direction, and betas less than 1, we have less risk, less systemic risk than the average stock, and we move in this direction. So here is the average stock risk, right there is the average stock's risk. And here's the expected return on the average stock, which is the same as the market. Because remember, a market index like the S&P is nothing but a weighted average of 500 stocks. So it's an average of stocks. Okay. So now, what you also need to know is, okay, so here you know you got more risk, you have higher expected return, you got less risk, you got less expected return, and this is the risk-free right here, you know that. Now, what you often see in this context of this graph is that if you have an expected return that's up here, so this is, if you have an expected return that's up here, for example, I'll just put a dot up here. And, let's say this is 10% right here. We expect a 10% return on the market, and then you expect a 14% return on the market, or a particular stock. So let's say a particular stock, you expect a 14% return, and this stock has a beta of 1. It happens to have the same beta as the market. You have a beta. So basically, you're looking at a stock that kind of behaves just like the market. It moves up and down with the market pretty similarly. So here, what we have is what this line is telling you is, look, this is telling you this is where the market is efficient. This is where supply equals demand for a stock. The market's in equilibrium along this line. There's no tendency for change. And what we're saying here is that if you find a stock that has a really high expected return, given what it should be priced at, given its systemic risk, then this stock is an undervalued stock. The price is low. And when the price is low, the expected return is high. So when you're above the line, you're looking at underpriced stocks. Okay? Now keep in mind that when the market is efficient, and when we study efficient markets, we're on this exactly on this line. And so then we're saying, look, if we happen to be off this line, we're dealing with an inefficient market. Securities are not priced the way they ought to be. And in this case, this is an underpriced stock, which means what will happen is underpriced stock means people are going to buy it because it's cheap. They're going to push the price up and the expected return down. And so the expected return is going to come down, and come down, right till it's in equilibrium, so that the return on that stock equals the amount of return it ought to, given its systemic risk that it has. And if we find the stock, maybe it's point here, and we look at a stock and we say this is stock T. I say, okay, given its level of systemic risk, that stock should be earning this amount of return up here. Should be up here. But it's only earning this amount of return. So this stock is overvalued because it has a low expected return. So this is overvalued. When it's under the line, it's overvalued. When it's overvalued, people are going to sell it. They're going to push the price down, and the expected return will go up to the point where it coincides with the security market line. And at that point, all stocks are appropriately priced given their systemic risk, and the supply equals demand. There's no tendency to change in the market. So that's when your textbook talks about market equilibrium. That's about it in terms of what that market equilibrium implies. It's nothing that sophisticated. It's really saying supply equals demand. That's market equilibrium from basic economics. And then, if you're off this line, there's a story on how you get back into equilibrium. You're in disequilibrium when you're off this line, and when you're on the line, you're in equilibrium. And so there's a story of over and undervalued stocks. It's not, that's about the depth of the concept of market equilibrium here. Now, one more thing here I want to talk about is, and that's alpha. So what alpha represents, what I've done here in each of these cases, is when you're off this line, you're off this security market line, and you have expectations than what they ought to be given the risks, then what you have is the concept of alpha. So alpha in this case was positive. Oops, I did an infinity sign. I didn't want to do that. White that out. So this is alpha right here. From here to here, this is alpha. And that's positive. It's a positive alpha because you expect a return greater than what's required given its risk. And here the alpha is negative because here the required rate of return given its risk is higher than what you expect. So alpha is measured this way. It's measured by the actual expected return, show you here, minus the required rate of return given its risk. So required rate of return. Whenever you see the word, this is required rate of return, the word required means it's required given its risk, and the measure of risk is systemic risk in this case. So when you find, when you go to various websites, there's on the web about the market, you're going to find one that's called Seeking Alpha. It's an entire website designed to give you information about the market so you can essentially beat the market given the appropriate level of risk. That's what it's saying. So you're comparing two securities, 2 points with the same amount of risk when you're looking at alpha. So for stock T here, we're looking at this point versus this point, the same level of risk. And that's what alpha is, trying to beat the market with the same amount of risk. And here, this is the same amount of risk between this point and this point. Alpha is not about comparing points, for example, this point to this point, because you get different levels of risk, and of course you would expect to have different amounts of return in that case. You got to compare given the same level of risk, which means you're somewhere on this axis at the same point. So let's do an example. Let's look at Shake Shack. That company went public this semester, and a number of people have been inquiring about it. The price of Shake Shack, the last price, was about $47 a share. Today's market, the risk-free rate, if you go to the Wall Street Journal, you'll see, ballpark. Let's say it's 1/4%. I think it may be a little less. But let's assume 1/4%. The expected return on the market's 10%. Now, people ask me where I get that. I just made it up. The market has earned about 12% over the last 80 years on average. So, 10 to 12%. So I picked 10% as a number because it's close to what statistically has happened in the past. Now, the thing that we need to address is what is the beta of the stock. Now, the beta of a stock can be found in most websites. You go to Finance Yahoo, you go to Finance Google, and Wall Street Journal, you'll find the betas of stocks. The beta of Shake Shack is not out yet because the stock is so new, they have not been able to compute a beta. And it would take another video for me to describe how to compute a beta and the issues around that. You can ask me in class if you like. But I'm just going to make up a beta, and here's how I'm going to reason it. I'm going to say, look, Shake Shack, it's food, so food itself can't be too volatile, but then again, it's discretionary food to some degree. It's not luxury. And it's a new stock, small market. Maybe, if it was an average stock, it would be a beta of 1, but maybe it's a little more risky than the market. Maybe it's 10% more risky. And so I give it a beta of 1.10. So it's good to keep in mind that when you have a beta of 1, it's exactly the same as the average stock in the market, like the S&P 500. If you have a beta of 1.10, that means it's 10% more risky than the average stock in terms of systemic risk. And if this was 1.50, it would be 50% more risky than the average stock. If the beta happened to be instead 0.80, it would be 80% as risky as the average stock, and so on. Now, keep in mind, Shake Shack is not on the efficient frontier. It's an individual stock, so it's one of those little X's on the interior of the efficient frontier in the inefficient space. But look, I'm going to be able to price it, in other words, determine its expected return using the security market line. And why can I value an individual security like Shake Shack when it's not an efficient portfolio in and of itself? Well, because what I've done is I've extracted, and this beta extracts the systemic risk of this stock. And so it takes the total risk and it multiplies it by the correlation between Shake Shack and the market. So here's the correlation between it, times the variance or the standard deviation of Shake Shack times the standard deviation of the market divided by the variance of the market. So it's all scaled by the market here. So what I've done was I plucked out of the total risk, I plucked out only the component that's associated with systemic risk. And so now, from this, let's do some analysis. Let's assume now that you bought this stock, it's at 47. Say you bought it just now, and you expect personally, without doing any of this security market line stuff, you decided the stock is going to go up to $60 a share over the next year. That turns out to be 60 divided by 47 minus 1, about a 0.277. almost 28% return. And so that's pretty high. And so let's see if we can use that in conjunction with the security market line to see whether or not we think this stock is over or undervalued. So, but before I go further, let's actually compute the expected return on Shake Shack. So the expected return on Shake Shack equals the 0.25% risk-free rate plus 1.10, the risk, and it's 10% more risky than the market for Shake Shack, systemic risk measure, and then the market risk premium, which is 10% minus the 0.25% for the risk-free rate. And we do this calculation, we get 10.975%. We expect about 11% return for this stock. And think about it. It's about 10% more risky than the market because the beta is 10% more risky. So that kind of makes sense. We can check to see whether or not things line up mathematically and the Sharpe ratios are all equal. We can do that quite quickly. For Shake Shack, 10.975 minus the 0.25%. That's the risk premium on Shake Shack itself divided by the standard. Oh, divided by, and here's the thing. You could do it by sigma, right? And you could compare this to the market, which was 10% minus a 0.25%. So there's the market risk premium. And you can take this sigma M and you take the sigma of Shake Shack. But we don't have that here. We don't have these two guys here. So what's cool about the capital asset pricing model is that you can insert beta in here and it'll also work. In other words, these ratios, risk-adjusted return ratios, in this case now adjusted only for systemic risk, will match up because they're all going to be on the same line, the security market line. So what I'm going to do is I'm going to put the beta of Shake Shack here, and this is the beta of the market. And so all stocks, all portfolios, including the market, which is a portfolio, will all have the same risk-adjusted returns, except now the risk adjustment is systemic risk only. So if you do the calculation, it's this, by the way, beta equals 1.10. This is beta 1.0. So when you do the math, 9.75 equals 9.75. Everything works. We are on the line. So what does the line look like? So here we have beta of Shake Shack. Here's the expected return. Shake Shack. We got a 0.25 risk-free rate. So there's the intercept. This is the security market line. Beta of 1.0. That's the market. M. That's got to be 10% according to what I gave you in the problem. Now, Shake Shack has a beta of 1.10. It's got to have a return that's a bit higher than the market. Right? Here's M. And that is, it's 10.975. So here is Shake Shack right there. Okay. Get rid of this little M's because it's a little confusing. Get rid of that guy. Okay. Now, given its risk, right, we expect, and we have an expected return of 27.7%. Holy mackerel, it's way up here. In fact, it's off the scale. So I'm kind of forcing it in this graph. But what I'm saying is this difference right here is going to be the alpha, the Shake Shack. And that's 27.7 minus 10.975. So the alpha is 16.725%. So it's got the same level of risk because I'm on the same line here, right? So this alpha is automatically adjusted for risk because we're looking at the same amount of risk here. And it says, look, this is security is expected to earn almost 17% more than what it should given its risk. So this is the required rate of return for the stock. Right, for a stock given its risk is this line, and the exact required rate of return given this beta 1.1, this is the required rate of return on the stock. Now, if your expected return equals, there's equilibrium, but your expected return doesn't equal. It's well above, which means this stock here is undervalued. It's undervalued, it's above the line. And so people, if the rest of the market sees what you see individually, then what's going to happen is they're going to buy up this stock, push the price up, and the return is going to come down to the point where it's on this, till the expected return now equals the required rate of return of about 11%.